no matter the stage of growth of your franchise system, whether you're a new franchisor or you're closing your 100th deal, you need to plan your exit strategy, what private equity investments look like, what an acquisition looks like, and most important, how to prepare right now to maximize the value of your franchise system. I'm really glad to welcome my partner, Brian Lincer. This is an important video that's really has its roots in so many conversations with our clients as we advise new franchisors and establish franchise systems, which is, how can I prepare today for an eventual exit, potential equity investments, even if it's never going to happen? What are the best practices? What are the strategies that you need to start adopting right now and thinking about? So, Brian, this is going to be a good conversation today.
Thank you, Charles. I think it is going to be a good conversation. Yeah, we get this question a lot. It's something that I always think about when I'm drafting the initial FDD. I'm really thinking about the exit strategy, and there's a few different ways brands can exit. Private equity is one of them, and that seems to be the most popular one lately. But there's also, generational, inheritance, passing it down to your kids, passing it down to people, someone else in the family, selling it not to private equity, just selling it to another conglomerate, and they're going to put a bunch of brands together. So there's, private equity is not the only way to exit a franchise system. But when I'm thinking about it, as I'm preparing the FDD and franchise agreement, I'm thinking about private equity, because private equity is the one that's going to scrutinize it the most. So I think if we're prepared for a private equity exit, we'll be prepared for all the other exits. The other exits will be easier. So I think of it, as if we're going to sell to private equity 5 years from now. And then that's the way I think about pretty much everything, not only the FDD, but every time I deal with a franchisee on behalf of the franchisor, vendors, every component of a franchise system has something to do with the private equity exit.
I think that's a great way to focus on it, right? Everything beginning with the end in mind, right? And so that means for new franchisors, as we're developing the FDD and really the development strategy embedded in it, it's always, what does that 3 to 5 year vision look like? What does a potential equity investment in year 4 and 5 look like? And how do all of your documents and your compliance practices hold up, right? So that's like category 1. Then we have brands that are in acceleration mode. Some have already taken on some private equity and they're at the second stage of their growth, and other more mature systems. But I think the answer along the way is you have to build in your compliance systems or your exit strategies. One, what you're saying, Brian, in developing your franchise program, but then 2 is how you maintain compliance, right? So we have FDD development, ongoing compliance. And then I guess the third category, which I'd like to just frame up here, is franchisee relations, right? How you're dealing with defaults or compliance or coaching. So let's assume we're close to a private equity transaction. What are the things that you're going to be looking at now as you're going through a deal, or something that someone 5 years from now, as they sit down in an equity transaction, is going to be evaluating that they would have wished they had done better or thought about more if they could have gone back in time?
Yeah, that's a great question. So what I think about, a part of the sales document and the agreement between the private equity firm and the franchise system that's selling there's an area called the representations. Basically, they're the promises of the seller, that they're making these promises, and if these promises are inaccurate, there's some repercussions typically, right? So I'm thinking about this on day one, because a lot of those representations will trail back 5 years from now, right? So an example of a representation would be, in the past 5 years, have you been involved with any litigation with the franchisee? and as a franchise seller, I want to be able to say no in most instances, unless we can't avoid it. Same thing with, franchise compliance. Have you ever had an issue with, a state as far as registration goes? I want to make sure our answer is no, and we can say that confidently without having any issues. So,
Brian, if I could just frame this a little, because these are really important points. So for franchisors out there, right? When you get to that private equity deal, a sale, the transaction is going to have some contingencies in it, or at least representations where you as the seller, whether of some equity, private equity investment, you're representing to the buyer that, hey, our franchise system's compliant. We've complied with federal and state franchise laws. They'll even get to, and I'd like to circle back on this too, Brian. They'll have questionnaires and information. Have you made financial performance representations, right? And so why does this matter to you as a founder or leadership team member? Your compensation may be tied to making sure first of all, you need to make those representations for a deal to happen. And second, even after you close a deal, if they're false, there could be an ability for a buyer to come back and either claw back compensation, or you could have liability. I mean, is that the area? Is that what we're focused on here?
Yeah, absolutely. And those are the things that are essentially controllable to a certain degree by a franchise system. So if we think we're selling to private equity in 5 years, and we know we're going to have to make those promises, those representations, we want to make sure our compliance program, addresses those issues, and we can, confidently say, without having any possibility of repercussions, we can say those things affirmatively and say, yeah, we have no issues, or yeah, and it's not unusual where sometimes, we have a litigated matter that's out of our control, right? So we, maybe we had a rogue franchisee that tried to open up a competing business, and we could say, we didn't have any litigation except for this one instance. Here's the information about that, which generally won't be seen as a negative. But yeah, absolutely. We're trying to figure out ways where we can make those representations without having the private equity company come back after us and potentially claw back, like you're saying, claw back some money or
having liability. Well, look, at a foundational level, right? Preparing the FDD, just basic infrastructure. Your franchise agreements need to be assignable. You need to have provisions that allow acquisition, allow you to be acquired without requiring franchisee consent, right? But then also to Brian's point, which is you need a very robust development in terms of anyone who acquires your brand is going to be looking for expansion opportunities. So you need to be really precise on how your agreement grants franchise territories. Do you have carve-outs for certain captive market accounts? And is your IP and your entire infrastructure protected? No. So what would be some examples of things you see private equity, like specific examples, really scrutinize or get concerned over when they're making an investment or acquisition?
So what I see most, where the lawyers for private equity typically focus, would be on those types of liability issues, right? That's number one, right? They want to make sure they're not buying something that's going to explode a year from now, right? So they're going to make all these promises that you're not aware of, litigation, any defaults, non-compliance, right? So they're gonna want to flush that out. That's probably the biggest area. Other areas would include, taxes, making sure, all the taxes are paid, making sure, all of your vendor agreements are in order, right? If you have particular vendor agreements, and making sure those are assignable. A big one that franchisors often forget, key employees. I think this is a big one where a lot of, the system could hinge upon one or a few key employees, whether that be the founder or, a management team. member. Sometimes they would want to see that employee locked up in a contract if possible, right? Because they're going to put a lot of value on that particular employee. So that's an area where you can win, and a lot of people aren't paying attention to those types of things. Like, how do we retain talent? Because that's going to be attractive to private equity. So these are the types of things that we can actually control. And like you said, IP, really important. Making sure our trademarks are registered, making sure that all of our renewals are filed correctly, making sure our whole IP portfolio is protected, whether that be trademarks, copyright, patent on occasion, right? So these are the things that they're going to look at generally. So knowing this and knowing that we're going to have an exit, and there's other factors as well, but those are kind of the big high level ones. Knowing that we can try to address those things in advance, so we don't have to deal with them at some point in the future.
Well, which is right. I guess the whole foundation of what we do as franchise lawyers, and really what our representation is built around, which is every deal that a franchisor closes, every deal that you close, there's residual value in that contract, right? And that, ultimately when private equity comes in, they're going to evaluate and value your franchise system based on really a cash flow model, which is, what is the EBITDA of your franchise system? And based on your industry and your growth, what's the multiple we're going to apply to that cash flow? And then also, what's the ratio of revenue? What percentage of your revenue is from royalties, which is the preferred, versus initial franchise fees, right? Which show different levels of growth. And so I guess when we approach every deal, it's really creating the compliance, which is FDD, properly disclosed, check mark, right? FDD receipt, properly signed off, check mark. Franchise agreement, properly disclosed and then executed with the right waiting period. Also, a big factor then comes into play, which is the negotiated addendums in the franchise agreement, right? And then on top of all of that are best practices, compliance practices, not making unlawful financial performance representations, having a well-developed, and I think this is one of the most underutilized opportunity, which is the better your item 19 is, the more protection you'll have. Not only will it help with franchise sales, but get rid of the ambiguity of bad item 19s and make sure you're drilling down with your team members on good sales practices. So I love when we're going through an equity deal and due diligence just flows really well. It's like our team uploads to the transaction vault the whole compliance folder, and it feels great when we go through that process, right? So back to Brian's points, right? Key cornerstone items, FDD compliant, item 19 compliant, focus on vendor agreements, controlling your litigation, right? And controlling franchisee relations in a productive way, addressing issues of non-compliance. Brian's really good point, which is having a pathway to maintain key employees for that transition, taxes, and then policing your IP, your registrations, your renewals, but also policing it, right? If there's third-party usage out there, you need to be strategic and aggressive, right? Be very cautious, right? So those are some cornerstone items. We know how this all comes together. So if you're watching this video, what does a private equity deal look like? Well, at one point, there's going to be a digital vault. All of your files are going to be uploaded, right? And they're going to be checking FDD, registrations, registration notices. What do our addendums look like? And those that, receipt pages, those are base level compliance issues, right? So getting to the next stage, Brian, we see this all the time. when you're negotiating these deals, the most important document is probably that LOI, the initial letter of intent, because that's going to have the valuation mechanism in it, potentially assumptions in it. But also, I think one of the most important things on a deal, and something I was talking about today on a potential transaction, post-closing indemnification, right? So if I'm selling my franchise system and getting an exit of $10 million, right? Talk to me about the post-closing indemnification, how it comes in, and why founders and equity stakeholders, what they need to be thinking about it as they're negotiating the initial LOI.
No, absolutely. And that's the key. You know, when you're selling your franchise system, and this is the case for any business that you're selling, you know, there's two components. One, how quickly am I going to get my money, right? And that's why you're selling the business for the most part. But number two, what is the potential liability for me afterwards? And that's this indemnification, aspect of it. So it's critical that it's flushed out at the outset. You know, as a seller always wants to get the money as soon as possible and cut off liability as soon as possible. Now, from the buyer's perspective, the buyer doesn't really know, you know, the buyer's going to do, there's certain things they can do, you know, do lien searches, public record searches, you know, search PACER, which is the federal litigation database, right? So there's certain things they can do publicly that they can get information, but there's a lot of information that they can't get from those things, you know. So for example, if there is some class action brewing in a franchise system, meaning that there's franchisees that are you know, getting together and they send a notice to the franchisor, that's not going to be anywhere in the public record, you know, that a buyer can see. So they're going to rely on those representations, those promises. Now that promise is going to say you're not aware of any potential litigation with the franchisee. So that's going to be that representation. Now, from an indemnification standpoint, if you breach a representation, if whatever you say is not true, the purchaser has the potential to sue the seller and say, well, you misrepresented this, you knew about this lawsuit, now I'm going to sue you, right? So as part of the LOI, and you're 100% correct, generally a seller of a franchise system is going to want to have some sort of cap on that, you know, and it could be a monetary cap, it could be a time lapse, you know, after a year, it's not going to, you know, the indemnification obligations are going to subside. But that's a really one of, if not more, just as important as the money, is that limitation for that indemnification is just as important, because we want to, as a seller, you want to make sure you cut off that liability as soon as possible. So that has to be negotiated at the outset as a material part of the transaction, and saying that, you know, we're going to cap any indemnification liability at X dollars, right? So if I know I'm getting $10 million, I know my worst downside is, you know, 500,000 or $1 million, whatever the amount is. So you can adjust for that. You know, if there is no cap, that you could potentially get sued for $10 million. So what was the purpose
Right.
of selling the system?
That's a big takeaway point, right? So as important as how much money you're selling for or the equity coming in is what's the maximum liability you're going to have on a post-closing indemnification, right? So the example I give, you've done nothing wrong, but plaintiffs' lawyers make up stuff all day, right? And so assume what happens next day, plaintiffs' attorneys come in, they sue you, they're lying, but of course they're going to allege everything on the plan said you made fraudulent and illegal financial performance representations. Now you're going to look at your counsel and say, I didn't do it. But you've also sold a significant portion of your business. You don't have that cash flow in. You don't want to be giving back money. So what is the maximum exposure on that post-closing liability, right? So, and Brian's point, which is important, which is you really need to negotiate that in the LOI. That's a key issue. And then what'll come up, and I don't want to get too bogged down in it, something I know Brian's a big proponent of, in these transactions, we call these, what you're making, reps and warranties. You're selling. You're going to make representations and warranties that are franchise companies in good standing, that we're in compliance with franchise laws, or we don't know of any violations, that we haven't made illegal financial performance representations. In these transactions, there are insurance products, representations and warranties insurance that should be considered as part of a deal that would come in and potentially compensate on claims. Brian, without getting into too much on insurance, what do you recommend, or just a basic overview of how reps and warranties insurance comes in?
So, so really it's what we were discussing, today. Any of those reps and warranties that are not, and this is where all this indemnification comes in, right? When we misrepresent something, if everything we said was true and everything we disclose is true, we're really limiting any exposure in that sense. But like you said, there are instances where we're not gonna even know, right? And that comes down to the language also. To the best of our knowledge, we don't know of anything, right? But there's still circumstances that do come into play where indemnification is going to be a part of this. So the reps and warranty insurance covers, and there's a lot of limitations to it. So I don't love relying on it.
There's always don't rely on it, right?
Right.
There's always limitations to insurance. It's like you're covered, but you're not covered. And here's the you're not covered endorsement. I get it. Right.
Exactly.
So I guess the takeaway there, is be aware of reps and warranties insurance. Don't rely on it. Plan for a worst case scenario where you cap your liability. Okay. And then I think we have a good template here. So now, like, if you're watching this and you're a startup franchisor, I think a big takeaway is my FDD not only needs to exist today, but it's going to exist 5 years from now. The franchise agreement I sign is an asset that forms a part of my future EBITDA valuation. It's going to be scrutinized by private equity, so it needs to be on point. And I won't go into it, but there's companies out there doing franchise agreements and FDDs that are not law firms. And I'm not saying this to be critical, but when I have these conversations with franchisors, what bothers me the most, Brian, especially when you're in a regulated industry. So I'm not just talking about franchising. I'm talking about if you provide a service that's regulated, for example, in a healthcare space or some other regulated industry, and the FDD doesn't account for the regulation and how you structure the agreements, how you achieve compliance on a state-by-state basis, you're destroying the future value of your franchise system.
Yeah, absolutely. We see it all the time.
We do.
We see these FDDs come into play, and it's, short term, maybe you're saving a few dollars, but you're definitely, hurting yourself extremely on the back end when all this, comes into play. And at the same time, you're going to be dealing, just like when I think about having a transaction where we could just upload all those documents to the data room, everything's compliant. We don't have to worry about a thing. Having the opposite, be the case when you're dealing with others who aren't thinking about that, when now you're misrepresenting certain things, you're scrambling to get documents together, everything kind of looks like a mess. Private equity notices that, and that's going to be accounted for. That extra risk, because it's sloppy, is going to be accounted for. So they're not going to agree to that cap. They're not going to agree to the same cap they would if everything is kind of organized and in place and everything's structured properly. So your exposure down the road is going to be that much greater.
Well, I love the way you're phrasing that, though, right? It's going to be accounted for as extra risk, which means you're going to get less money, or you're going to lose a deal and your competitor is going to get it. If your competitor has better compliance, one thing too to keep in mind as a franchisor, as you're negotiating these addendums about royalties or brand development fund fees or the economic provisions, which can potentially create inconsistency between your franchise agreements. Franchisee A has a cap on brand fund, franchisee B doesn't. That's where you need to be careful, because Now you have other issues which relate to franchise relationship laws, but now those are going to be very scrutinized once you get involved in an equity transaction.
Yeah, and it's going to say, you know, the actual language in the contracts going to say, you know, you know, have you violated any law, right? And you may not even be aware of it, or you know, and that's 100% true. So we have to make sure as we're going through this, even years ahead of time, that we can say that confidently we have not violated any law. So all of those situations and all of those negotiations, you know, it's pretty typical in the beginning of a franchise system to have some leeway. You know, we always kind of go back and forth with our client to make sure we're kind of keeping them, you know, in between a certain. We don't want to go too far because then it creates other liabilities. So it's something, but that's what I'm thinking about. Even on the first deal, I'm thinking about the private equity deal 10 years from now, where I can, you know, actively say this and say that with confidence that we have no issues. And it also leads to more litigation, you know, the more disparate. So it's going to increase the risk that we have litigation that we're going to have to disclose, which is going to hurt us down the road. So
yeah, I love that example because unless you go through it and see it legally, it's crazy, right? So a provision in a franchise agreement says you're compliant with franchise laws. Well, there's some states that have franchise laws that say cannot engage in disparate treatment. Like it's that basic, right? So that's a great example. Process-wise, I think you agree, right, Brian? That LOI is really it really sets in motion the future trajectory of the deal, no?
Definitely. Yeah, it's so important it's the foundation, right? So the lawyers are going to take that LOI and create the, you know, the acquisition documents based over that LOI. And also you don't want to waste time and resources, you know, kind of going through it. You're going to be disclosing a lot of confidential information. You know, we don't want to do that unnecessarily. We don't want to go through that process. We don't want to hire lawyers unnecessarily, and accountants, and go through that process. So, you know, negotiating that at the outset, I see a lot of people not negotiating those caps on indemnification, and that's such a big issue, because at that point now we're you know 5 drafts into the agreements, and now we're discussing it, but we've already committed tens of thousands of dollars and months of time, and you know, it's just not worth it. But I see a lot of you know, attorneys and people, accountants, kind of forget to do that, and they don't really think about it at the outset, which is a mistake. So you got to flesh out those issues for sure.
Well, and then as that's happening also, I think it's important to really hone in on the confidentiality provisions of the negotiations. You don't want all of this leaking out to your franchisees, and you really want to contain the deal. And if you're working with a bank or an advisory group, also, you know, that comes up often where we're negotiating those agreements. So you really want to structure this well. That LOI is really a foundational item. And it's interesting. I also think, Brian, and we spoke about this, sometimes the deals don't work out, but they make you a better organization, because going through the process flips a switch and really helps you focus on, you know, all these due diligence factors that, sure, that you need them for a deal, but they're also indicators and signs that you're building a solid system. And so we see it all the time. If a deal doesn't work out, it's just setting the foundation for something better in the future.
100%. Yeah. And that's kind of the perspective that we have doing a ton of all these deals over the years. And that's what I try to convey to our clients who are just starting out, who don't have that, you know, that experience or, you know, perception of things. So sometimes I have those types of conversations, you know, with our clients and you know, talking about, you know, 5 years from now, this is something that's going to have to be addressed. So I want to deal with it now. Let's deal with it now, and we never have to worry about it. But yeah, it's so important. And you're right. It exposes a weakness. Going through the process, it may expose a weakness if it doesn't work. And then you see the shift happen where they say, okay, well, the next deal that comes along, we want to make sure we don't miss that one. So we're going to change things, and but if we can do it from day one, that's really the goal, and we don't have to retool.
So anyone watching, Brian in our office leads our team. We're really big in traction. We have our weekly traction meetings. This was one of Brian's rocks, because these issues come up so often. And Brian's like, I want to get a video together for our clients, just as a primer video as we work together. And so this is good, Brian, because this is a rock. Anything you want to leave off with here?
You know what? I just think, like anything else, if we're paying attention to it on day one, it makes life so much easier. And even from a tax perspective, I was just involved with a situation where this accountant saved $1 million out of a $5 million deal because they structured it properly from day one. And it's hard to see that from day one, from the beginning. But you have to have trust in your advisors that they've been through it and they're paying attention to those things. So whenever I'm talking to a client, I came back from the future, right? I lived the whole system up until the sale of the point. Now I'm coming back to tell them this is the way it should be done, because I can kind of see what happens in the future, and that's just based on experience. So you need to trust your advisors, your attorneys, your accountants, the bankers involved. You really need to do that, and the earlier you can do it, the better. It's going to be much easier to do it from the beginning, and much harder as you go to try to shift later on. So try to do it from day one, or get started right away.
Brian, that's awesome. This is good. Brian, I think we did good. And if anyone out there, we could help you out in any way, just let us know. Thanks, Brian.
Absolutely. Thanks, Charles.